November 1923. A German woman burns cash in her stove because it's cheaper than buying firewood with it. A single postage stamp costs 50 billion marks. Workers demand to be paid twice a day. Not for extra money, but because by lunchtime their morning wages are worthless. That's hyperinflation. And here's the question that keeps economists up at night. Could it happen to the United States? Most Americans think it's impossible. The dollar is the world's reserve currency. We're not some unstable developing nation. Our institutions are strong. But here's what history actually shows. Every country that experienced hyperinflation said the exact same thing right before it happened. And today, 3 specific patterns that preceded every major currency collapse in the last century are quietly emerging in the American economy. If you want to understand what these patterns really mean for your savings, your purchasing power, and your financial future, you're in the right place. Let's dive in. First, let's get clear on what we're actually talking about. Hyperinflation isn't just high inflation. According to the International Accounting Standards Board, hyperinflation is officially defined as cumulative inflation of 100% over 3 years, prices doubling in that time frame. But the real-world cases we remember, they were far worse. We're talking about daily price increases, currency that loses half its value in hours, and economic systems that completely break down. Now, I know what you're thinking. That could never happen here. And statistically, you might be right. The US has massive advantages: deep capital markets, the strongest military in history, and that reserve currency status I mentioned. But let's be honest about something. Every nation that fell into hyperinflation had advantages too, and more importantly, they all ignored the same warning signs. Quick note before we go further. This video is for educational purposes only and does not constitute financial advice. Always do your own research and consult with qualified professionals. Now, let's look at what history actually teaches us. There's a pattern to currency collapse that repeats with eerie consistency. I've studied 8 major hyperinflation events from the last century, and the same 3-stage setup appears every single time. Stage 1, massive debt from a crisis. Stage 2, loss of economic productivity. Stage 3, printing money to cover shortfalls. Sound familiar? It should. Let's start with the poster child of Weimar Germany, 1921 to 1924. Here's what most people miss about the Weimar collapse. It didn't start with printing money, it started with debt. Germany owed 132 billion gold marks in World War I reparations, about $442 billion in today's money. That's already crushing, but here's the killer. Germany's industrial heartland, the Ruhr Valley, was occupied by France and Belgium in 1923. Suddenly, they couldn't produce their way out of debt. The German government faced an impossible choice: default on everything, or print money to pay obligations. They chose printing, and this is where it gets interesting. At first, it seemed to work. People had jobs, the government could pay bills, but the Reichsbank printed 92.8 quintillion marks in 1923 alone. By November, $1 equaled 4.2 trillion marks. A woman named Fanny Bender, a Berlin widow, told historians she carried money in a laundry basket and had to shop immediately because prices changed hourly. By the time she got to the butcher after the baker, meat had doubled in price. But here's what keeps me up at night about Germany. It wasn't some backwards economy. In 1913, Germany was the second largest economy in the world, a leader in chemistry, engineering, and manufacturing. They had sophisticated institutions. They had a central bank. They had all the advantages, and it still collapsed in less than 2 years. You might be thinking that was a special case, a war-torn nation with occupation. Fair point. Let's look at Hungary, 1945 to 1946. The Hungarian pengo holds the world record for hyperinflation. At its peak, prices doubled every 15 hours. The largest denomination note was 100 quintillion pengo. That's a 1 with 20 zeros. Hungarian economist Laszlo Danos documented families who gave up calculating prices entirely and just handed over fistfuls of cash, letting shopkeepers take what they wanted. Hungary's pattern was identical. World War II destruction gutted productivity. The government needed to rebuild and pay debts. They printed money. The National Bank of Hungary increased the money supply by 1.19x 10 turbo over 27%. To put that in perspective, that number is larger than the estimated number of stars in the observable universe, and this happened in just 13 months. Now, let's jump forward to something more recent. Zimbabwe, 2007 to 2009. This one matters because it wasn't war-related. Zimbabwe had a different crisis. Political seizure of commercial farms destroyed agricultural exports, which had been the backbone of the economy. Productivity collapsed. Tax revenue dried up. The Reserve Bank of Zimbabwe started printing. By November 2008, inflation hit 89.7 sextillion% month over month. They printed a $100 trillion note. A Zimbabwean teacher named Margaret Ndlovu told reporters she was paid 400 billion Zimbabwean dollars weekly, enough to buy 3 eggs. Her life savings, built over 30 years, couldn't buy a single loaf of bread. Think about that. 3 decades of work, gone. Here's the pattern across all these cases. Crisis reduces productivity, government prints to maintain stability, confidence breaks, velocity increases, hyperinflation hits. The time from everything's fine to currency is worthless is shockingly short, usually 18 to 36 months. So let's talk about America. Are we seeing these patterns? Pattern 1, massive debt from crisis. The U.S. national debt is currently over $36 trillion. That's about $107,000 per citizen, or roughly 123% of GDP. During COVID-19, the U.S. added nearly $5 trillion in debt in just 2 years. The Congressional Budget Office projects that by 2034, debt will reach 122% of GDP under current policies, and that's their optimistic scenario. For context, when debt to GDP exceeds 90%, economic research by Carmen Reinhart and Kenneth Rogoff shows growth typically slows significantly. We're already well past that threshold. Now, here's where it gets really interesting. The interest payments on that debt are exploding. In fiscal year 2024, the U.S. paid over $892 billion just in interest, more than the defense budget. The Congressional Budget Office projects that by 2034, interest costs will exceed $1.6 trillion annually, becoming the single largest federal expense. We're borrowing money to pay interest on money we borrowed. That's the debt spiral that precedes currency crisis. Pattern 2, productivity concerns. No, the U.S. isn't Zimbabwe. We haven't lost our productive capacity, but there are warning signs. Labor productivity growth has been slowing. According to the Bureau of Labor Statistics, productivity growth averaged 2.8% annually from 1948 to 2005. From 2005 to 2019, it averaged just 1.4%. Since 2020, it's been volatile, sometimes negative. Meanwhile, workforce participation for prime-age workers still hasn't fully recovered to pre-2008 levels in some segments. And here's something most people don't consider. The U.S. trade deficit. We import far more than we export. About $773 billion more in 2023, according to the U.S. Census Bureau. That works because the world accepts dollars. But what happens if that changes? We'll get to that in a moment. Pattern 3, money creation. This is the big one. From 2020 to 2022, the Federal Reserve expanded the money supply at rates not seen since the 1970s. M2 money supply, basically all the dollars in circulation plus savings accounts, jumped from 15.5 trillion in February 2020 to 21.7 trillion by March 2022. That's a 40% increase in 2 years. Now, the Fed will tell you this was necessary to prevent economic collapse during COVID, and they might be right. But here's the uncomfortable truth. That's exactly what every central bank says right before hyperinflation. This is different. This is temporary. This is necessary. The National Bank of Hungary said it. The Reserve Bank of Zimbabwe said it. The Reichsbank said it. But wait, there's something even more important here. The U.S. has a massive advantage that none of those countries had. The dollar is the world's reserve currency. About 60% of global foreign exchange reserves are held in dollars. International trade, especially oil, is priced in dollars. This creates constant global demand for U.S. currency that other nations never had. It's a pressure release valve. Except that valve might be closing. According to IMF data, the dollar's share of global reserves has dropped from 71% in 1999 to about 58% in 2024. That might not sound dramatic, but the trend is accelerating. Countries like China, Russia, Brazil, and India are actively working to reduce dollar dependence. The BRICS nations are exploring alternatives for trade settlement. Saudi Arabia is now accepting yuan for oil sales. These are small shifts, but they're happening. Here's the scenario that concerns economists. If reserve currency status erodes significantly, all those dollars held overseas could flow back to the U.S. That's trillions of dollars suddenly chasing American goods and services. Even with our productive capacity, that could trigger severe inflation. And if confidence breaks, if the world decides the dollar isn't stable, velocity increases. That's when inflation becomes hyperinflation. Now, this is where it gets nuanced, and I want to be really careful here. Am I saying hyperinflation is coming to America? No. The US has institutional strength, economic diversity, and military power that create enormous resilience. The Federal Reserve, despite criticism, is sophisticated and independent. The dollar's network effects are powerful. Even if countries want to move away, there's no clear alternative. The euro has its own problems. The yuan isn't freely convertible. Gold can't scale to modern trade needs, but, and this is crucial, low probability doesn't mean zero probability. And more importantly, you don't need full hyperinflation to see devastating effects. Venezuela-style inflation, where prices doubled every 19 days at the peak in 2018, would destroy most American savings. Even sustained 15-20% annual inflation, like the US experienced briefly in the late 1970s, would be economically catastrophic for millions. So what should you actually watch for? What are the real warning signs? First, watch the interest payments. If interest on the debt exceeds 15-20% of federal revenue, that's a critical threshold. It means we're spending more to service debt than on most government functions. That's when the debt spiral becomes really dangerous. Right now, we're around 14-15%, so we're approaching that line. Second, monitor reserve currency status. Not the IMF percentages, those are lagging indicators. Watch what happens with oil trade, watch what China does with treasury holdings, and watch whether major economies start settling bilateral trade in currencies other than dollars. If you see a coordinated shift, that's significant. Third, and this is the big one, watch the Federal Reserve's balance sheet and M2 money supply. If we see another rapid expansion like 2020, 2022 without a corresponding productivity boom, that's a red flag. The Fed reduced its balance sheet from $9 trillion in 2022 to about $7.4 trillion by late 2024. That's good. But if another crisis forces them to expand again, the cumulative effect becomes more dangerous. Fourth, watch for political pressure on the Fed. Central bank independence is crucial. Every hyperinflation event involved political interference in monetary policy. If you see serious attempts to reduce Fed independence or pressure the Fed to monetize debt directly, that's a major warning sign. And here's something most people miss. Watch corporate pricing power and wage spirals. In the early stages of currency crisis, companies raise prices faster than costs increase because they expect more inflation. Workers demand higher wages to keep up. Companies raise prices more to cover wages. That's the feedback loop that accelerates inflation into hyperinflation. We saw hints of this in 2022, 2023, but it's stabilized. If it restarts and persists, pay attention. Look, here's the truth. The United States has significant structural advantages that make hyperinflation unlikely. But unlikely isn't impossible. And even if we avoid hyperinflation, high sustained inflation, say 8 to 15% annually for several years, would be devastating for most Americans. Your savings lose half their value in 5 to 7 years at 10% inflation. Retirement plans collapse. Fixed incomes become poverty. The lesson from history isn't that America is doomed. The lesson is that no nation is immune, and the warning signs are always visible if you know what to look for. Germany was an industrial powerhouse. Hungary was rebuilding. Zimbabwe had been a regional breadbasket. They all thought it couldn't happen to them. And then it did. The smartest thing you can do is stay informed, understand these patterns, and recognize that the decisions being made today about debt, money supply, and fiscal policy are laying the groundwork for whatever comes next. Will it be hyperinflation? Probably not. Will it be significant inflation that changes your financial reality? That's a much more likely question. And that's why understanding these patterns matters. Not to panic, not to bury gold in your backyard, but to make informed decisions, to understand what you're seeing in economic data, and to recognize when risks are increasing versus decreasing. If this changed how you think about currency stability and inflation risk, you'll want to check out our video on how countries actually recover from currency collapse. The patterns are surprising, and if you haven't subscribed yet, now's the time. We uncover these hidden patterns in financial history every week, making sense of complex economics without the hype or fear-mongering. Hit that subscribe button. We're just getting started uncovering the truth about global currencies. See you in the next one.